Welcome to the Matter Financial Report. I'm your co host, Tony Shore, and our host, Michael Matter, is here. That's right, the man with the plan. As always, Michael, looking great today. Whenever I see your smiling face, I have to smile myself because of financial stability. Changed James Taylor's lyrics a little bit from his song there, but we're talking about, is your retirement savings on track? And that's good to know. Whether you're 20 years from retirement, 1 year from retirement, or 2 years into retirement, where are you at? Are your savings enough? And I think this is a good question. It's a question I've had for you. And we've talked about this before, you and I know this is something you get asked a lot. Like, where am I? What do I need? What do I need to do to make sure I'm saving enough or have enough to last throughout my retirement? Isn't that the biggest question you get?
It's definitely one of the top questions that I get. It's the main concern that people have going into retirement is what is my retirement going to look like? And am I going to have to go back to work? Is everything going to be okay?
Yeah. Well, yeah, there you go. Is everything going to be okay? That's a good one. People are concerned, especially right now. They get concerned when there's market volatility. They get concerned when there's world events. But don't stop saving for retirement and make sure you're staying on track is the message here, right?
Right. So, Tony, we always talk about on the podcast about we don't like to generalize too often. We like to look at individual goals, aspirations. And when we reference articles, we always talk about how that's really a generalized opinion on what retirement should look like for everyone. When I work with my clients by putting together a financial plan, it's always going to be a one off. We're going to meet your goals, expectations. We're going to put in your actual um, situation into the plan to make sure that it's successful. But today's episode is going to be a little more generalized than we typically have on the show. So we're going to look at more generalized, you know, what retirement should look like leading up to retirement, what
Sure.
your account balances should look like. So, again, don't think, well, that's not even close to what I'm currently doing or where I'm at in life. Just know uh, when we put a plan together for you, we'll take your actual information, input it, and make sure that it is tailored for yourself.
Yeah, and I think that individualized attention is what you need. That's where cookie cutter retirement plans and, oh, I heard I need to save this, or I can use the 4% withdrawal rule, or I'll need a million two by the time I retire, or I'll need X amount, or I don't have to worry because I'll have Social Security and I'll have a 401k. But everybody's situation is different. I mean, there's a difference between men and women that you have to plan for, because a lot of times the husband will pass away first in the couple, and then the woman or the wife might live long. Typically, they live longer, up to 6 years longer than men. So then they have to deal with one Social Security income coming in and the loss of some income. So there are unique things even between men and women, aren't there?
Right. And again, so like we preference, it's just a generalized overlook on what
Yep.
financial planning might look like. Doesn't mean that that's what your situation will look like or
Right.
that all of these circumstances fit everyone. So, yeah,
Yeah.
you're right.
Yeah. So I know there are a lot of considerations out there when it comes to retirement planning. Where do you want to begin? What's one thing you want to talk about that we can cover in this topic?
Right. So, if we're looking to see if we are on track for retirement, maybe let's roll back to the accumulation phase while you're still employed and maybe early on in employment. How can we make sure that we're on track at that phase of life?
Yeah.
Um, So we're going to look at U.S. News and World article, retirement tips for men or actually roll that back. The actual title of the article is retirement tips for women and men too. So essentially they're saying retirement tips for everyone. I think we all fit one of the two categories. Um, and what does it look like, you know, to get ready for retirement?
Yeah. Exactly.
And so we've talked about this on previous episodes, but let's just start off with 401k plans.
Yeah.
There's been some changes recently with legislation, In the past, it wasn't really a requirement for your employer to offer a 401k or some sort of a retirement savings account, but it's pretty much legislated in that if you are working for any foreign employer, at some point they're going to have to basically offer you an opportunity to invest in a retirement account.
Yeah. Yeah, and that's true, and a lot of people think, "Well, I'll just, put a little bit of money into my 401k, I'll be fine." But you need to make sure you're putting in enough to get that match, right? That's the first you gotta make sure you're putting enough in there and then enough to get the match, right?
Right. So find out, does your employer offer a plan? If they do, make sure that you're enrolled. Find out what your employer's retirement plan looks like for you. So if they are offering you a match, the minimum that you should be contributing is up to that match. But that gets back to, like you just mentioned, that should be a minimum. You should start to budget to make more than just a minimum contribution to your retirement accounts, whether it's in the 401k, outside of a 401k. You should be contributing towards some sort of a forced savings account of more than 3 to 6%. It should probably look like 10 to 15% of your paycheck.
Right. Yeah. So, okay. So, you especially once you reach a certain age, at least 10 to 15 is what you're saying, right?
And the earlier you start, the better off you're going to be. Maybe you get to retire earlier, or maybe when you do retire at retirement age 65, 67, you'll have more discretionary spending.
Sure. Sure. And I think that that discretionary spending is huge too. People want to live comfortably in retirement. You don't want to take a pay cut in retirement. Nobody wants that.
No, you don't want to have to adjust your lifestyle just because you stopped working. That's not the point of retirement. The point of
Mhm.
retirement is to enjoy not having to work.
Yeah. Well, there's something when I was, when I was 21 and when I was working full time and had an opportunity to start contributing to a 401k, I did not. And I didn't for many years, and I wish I had. Now, though, it's the most companies have what's known as automatic enrollment into the 401k, right?
Right. So traditionally, usually when if your employer offers some sort of a retirement account, they will set up an automatic distribution to that account, whether or not there's a match involved or not. It's usually at a pretty low threshold, though, Tony. It's not going to be a 5 or 10% contribution. It's probably going to be 1 to 3%.
Sure.
And so that's not going to be enough. If you're only contributing 1 to 3% of your paycheck, your retirement account's not going to grow to the expectation that you probably have for yourself in retirement. So, meeting with your employer, if you already have a plan set up, meeting with someone that has a full understanding of what your employer retirement account looks like, getting a full understanding of what you can invest in, what you can contribute to would be important if you don't already know. If you're starting out at a new employer, finding out what their plan offers for you. And if there is an automatic enrollment, maybe bumping that up and finding out how to do that.
Yeah. Yeah. And so I know that a lot of employers that I've come across, their automatic enrollment is 3%. Where they start you, and you have to go in and set it if you want that to you can set it to increase every year. When you get a raise, it can increase by like 1% or whatever you set it to. But they start you at 3%, but you don't get the full match until maybe 6%. So you're actually leaving free money on the table then, right? If you just let I'm automatically enrolled, don't need to worry about that at 3%. Number one, you already said you should be contributing more than that. And number two, you're not going to get the full match at a lot of companies. So, I mean, it can be different. Maybe they match up to 3%, and that's all you can get anyway, as far as the match. But I know a lot of companies they'll match up to 6% or at least 50% on the dollar, up to 50 or up to 6%, which would be great. But if you're only putting in three, you're not getting the full match, right?
Right. So you're leaving money on the table up front.
Yep.
Number one, we never want to do that.
Right, that's a
And then you're going
mistake.
to miss out on the time horizon, right, of compounding interest over time. So that growth is really going to be hindered by
Yeah,
not making those additional contributions up front.
yeah, yeah. Well, and I think that that's important. Obviously, it is, a concern. People need to be aware of this. I think a lot of people set it and forget it. What I've started doing, and tell me what you think of this, especially once I turned 50 and then 55 is where I really kicked it down. My wife and I, um, every time we get a raise now, every year we get some type of a raise. Sometimes it's tiny, sometimes it's bigger, but we put that full thing into our 401k. So because it's money we never had, I'm not going to miss it, right?
Right. So if you don't have a need for it, and we've talked about this before, you should be really intentional with all of your spending and where your money's being
True.
allotted.
Yeah.
If you've already had that under control and you don't have a need for any additional expenses, rolling that additional money right back into a forced savings account like a 401k, as
Hmm.
long as you're not maxing it out, right? That's a pretty good plan. Um, we could talk about maybe other investment choices, but as long as that money's being invested and just not frivolously spent, yes, that's a good plan that you and your wife are employing.
Yeah. Yeah. I really think it's so important, and you hear that, and people are like, "Oh yeah, I've heard. I'm getting my match," but a lot of people aren't contributing enough to their plans to get the full match. That's why we keep talking about it, and it's huge. I mean, basically, it's part of your compensation that you're saying to your company, "I don't want that. I know you want to pay me more, but no, don't."
Well,
It's
yeah, you
like,
just mentioned who doesn't want to get a raise at the end of the year, and you've
right?
come to almost expect it, right? Every year you
Yeah,
said, "Well, I get some sort of a raise," so you're expecting your company to give you some additional compensation every year that you're working.
yeah,
Um, the
yep,
match right there is already a raise that you could give yourself. If you are not contributing at least up to the match, that's a raise in itself that you're not
right.
getting.
Well, it's true. That's true too. So, what else do we need to be aware of here? Obviously, automatic enrollment. We've talked about getting the match, and I think those default contribution rates are usually good but low. You said 10 to 15%. What else do we need to make sure we are doing to keep our retirement savings on track?
So typically we talk about pre-retirement and retirement on the show, right? Like getting close to retirement and making sure that you're ready to retire. But like I said, today we're talking more about that accumulation phase, maybe starting out your career. Just having an understanding of what compounding interest can do for you in the long term. So the earlier that you start, like you said, you had an opportunity at age 21 to contribute. Imagine what that account would look like today. I'm sure a couple of times when um, the money was a little bit short and you always thought about that one time that you wish you had invested when you were 21 and had access to that capital at that point in time. Just making sure that you start out young and start to build those habits early, but also understand that when you start your career, it's not going to be a straight line.
Right.
When you're starting out young, you're going to jump from job to job. Life is going to happen. Maybe a family comes along where you're forced to take some time off to take care of a kid. Maybe you get a little bit older and so are your parents, and maybe someone needs help with caregiving. So you have to take time off, and that's going to derail some of your retirement contributions. So just understanding that it's not going to be a straight line, but as long as you have a system in place and understand what that's going to do, not just for your bank account at the time that you're taking the time off, but it's how it's going to affect retirement. So there's a couple of areas that we'd like to get into based off of taking time off while you're employed.
Right. Yeah, and that's huge. And I think that when you look at things like that and taking time off when you're employed, you got to look at maybe take a break from the workplace to take care of their parents. I know I've been spending a lot of time because both of my parents need full time care and they're in full time care. I feel guilty if I'm down, not down there helping them, right? And so, I know people who have like, okay, it costs this much for them to be in a home, or they could live with me, um, and I could take some of that money and take care of them and not work. But then you're not paying into Social Security, and it's tough, or my spouse is working, I don't need to, and so if one of the other, husband or wife or, one member of the couple takes a break from work, those are working years. You're not contributing to Social Security. You're probably not putting money into a retirement account. So that is something that can derail a retirement savings plan.
Right. And so if you can plan around it, right,
Hmm.
maybe find part-time work so that you're not fully leaving the workforce, because there's some negative
Right.
effects if you're not employed and you want to go back into employment later. It's harder to find a job or get the compensation at what you think that you should be getting paid because you've taken time out of the industry. But again, Social Security is dependent on the amount that you've contributed to it. So you already touched upon that. If you can, right, have that part-time job and still fulfill those goals that you're
Sure.
talking about of watching your child or maybe going to help with your parents, sometimes it's not, you cannot avoid those situations, and so you just have to make those decisions, but just understand that there are some domino effects, that go into
Right.
that, and so planning for it is important.
Yeah, when you say the solution is always planning, right? And how you plan for that is maybe, like you said, part-time work or stay involved. See if you can keep doing your job from home part-time, or to stay connected in one way or the other. Because it's hard if you leave your work for 3 years and then try to jump back in the workforce, especially if you're, over 50 or 55, 60. Then as you get older, it gets harder to jump right back in. You might not enter at the same pay. Your job might not be there when you come back. So you have to understand those things and plan for it.
Right. So we all think that we're not replaceable until we're replaced, and maybe we're replaced at a
Right.
by someone that does it better and cheaper, so
Yeah, yeah.
you won't
Younger,
be missed as much
faster.
as you thought, right?
We're
I don't know if you've
younger,
ever
we're younger,
gone
we're
back to a
faster,
job,
and moms
Tony.
love us, right?
Yeah. I don't know if you've ever gone back to an old job where, uh, y you're excited to see everyone you used to work with, and then you go back a year after that, you're not as excited to see them, they're not as excited to see you anymore,
Right.
and then you go back a year later and no one that you worked with works there anymore either, and it's all turned over, and guess
And they're
what?
all younger.
They're younger, the business is still running, so we are all unfortunately replaceable.
Right. Yeah, we learn that the hard way sometimes. So, what else is something we need to look out for, in our retirement savings and making sure it's on track?
So just making sure that it's on track, if one of you does leave the workforce, just again understanding how that could affect retirement for Social Security later, especially if you're a married couple.
Yeah.
Um, I don't that we've talked about this a couple of times, but the widower's tax, when one of
Yes.
the two spouses passes away, you don't get to continue both Social Securities. So planning ahead to make sure that you have a reasonable amount of Social Security for the last remaining spouse and planning around that. So something that we do at our firm, Tony, is we put together a Social Security maximization report. It's very important in retirement planning to make sure that you don't just decide I'm going to start Social Security at 62 or 67 or 70. There's actually a reason for the time that you start your Social Security.
Yeah, when you file makes a huge difference. And everybody has a different sweet spot when, okay, the best time for you to file is 63 and 2 months. The best time for some people to file is right away at 62. Others, a lot of others, it might be or probably is their full retirement age, 67. But it might be 66 and 2 months, or it might be 68 and 3 months. It all depends on your personal time horizon, your personal financial situation. What's your spousal situation? Because if you lock in a lower amount, that can affect your spouse later, right? I mean, if you pass away first and then the remaining spouse is left with the higher of the two, if you locked in a low amount, then if both amounts are low, that's not good because you got to try to you're going to have to make up for one of those missing. Then you're not going to get both Social Security checks after your spouse passes away.
Exactly. And I think it's again based off your specific circumstance, and it's not based off of your neighbor's circumstances or coworker circumstances. uh it- they started at 62, I should start at 62, or I work with him and he's 65 and he's already taken Social Security, so I probably should be taking it too. um right, it's based off of your current circumstances. We have no idea, what your coworker, your neighbor, reasoning behind them starting it, whether it was the right decision for them or they had no idea what they were doing and they just enrolled with Social Security and started taking their payments, right? And possibly left a lot of money on the table.
Yeah. Well, and Social Security, basically what we're talking about and what you constantly say, Michael, is it's so important when you file. Filing for Social Security, they say the majority of people who file as early as possible at age 62, but it's not right for the majority of people. It's right for some. But a lot of people are doing that because their neighbor did, or their friend did, or a family member, or a coworker did. And everybody's different. You cannot base when you file on when somebody else said. And if you hear somebody on a radio show like this saying you have to file as early as possible, or you have to wait until 67 or 70, or the majority of you are going to want to wait. No, you have a unique situation. Have the report run, see what it says, then talk to a trusted financial services professional who's looking at your big picture and say, okay, you're going to rely heavily during this time and this time on Social Security. Your spouse is not going to have a very big Social Security check no matter when they file, or they have to file sooner because they're retiring first or something, or they've been forced to retire. So everything is circumstantial, but based on your circumstances, you want to make the right decision, because we're talking about the difference in a lot of money here. I mean, it can really add up. I mean, we don't have the article didn't give specific numbers that we're referencing today, but even according to the SSA.gov, the difference in between filing at 62 and 67 is about 30%. You're taking about a 30% hit, right?
Yeah, up to 70, 62 up to 70. It's about an 8% roll up every year that you can delay it up to
Yeah.
age 70. Yep.
Yeah. So that's rough. So you got to make sure you're making the right decision there. So we've talked about Social Security benefits, survivor benefits, and spousal benefits are so important. What else do we want to talk about?
Yeah, the other article that we want to reference today, it's a retirement savings on track question. How much you should have by age 60 or 65, and that's a Kiplinger article.
Sure.
And again, this is more of those generalizations that we really don't like on this show, where you should have a set amount of money if you're 65. Otherwise, you can't retire.
Yeah,
I just
that's
read an article the other day. I won't reference it because I don't know if they did their research. They used a very well known personality in the market and said their new target number for retirees is $5 million. If you don't have $5 million saved up for retirement, you can't do it. So, right, the number just keeps going up every year, and I bring that up because I just think that's a funny amount. I think anyone that had $5 million or close to it, yeah, they could probably comfortably retire, Tony. And if
yeah.
you don't, there's so many other factors that go into a number that you should have saved
Oh,
because
yeah, it's
there's things like
crazy.
pensions, Social Security, right? You don't maybe necessarily need to have a big nest egg saved up if you have guaranteed income already coming in. Or maybe you're just a very simple person, you have no debt, and you don't need a lot of income. So it's always individualized. So when we talk about these general constructs of what 60 and 65 should look like for you, just know everyone's individual circumstances are different.
Yeah, and the reason we keep driving that home is because that's why, if they weren't, and you could just use cookie cutter approaches and be successful and not have costly mistakes, then you probably wouldn't have a job, Michael. And the wealthier people, that's why they all work with financial professionals. And no matter how much or how little you have, it's so important to have that big picture and have an actual plan in place for your retirement income, and that it affects, you need a plan in place while you're saving for retirement. And that's what we're talking about today. And you're right. I mean, having that plan in place, it makes a difference. Everybody's situation is different and time horizon. But like you said, there are these articles you see, you need $1.2 million in order to retire and not run out of money. Well, that's crazy, because I know people who've done it on 500,000, and I know people who would need $4 million to live at least and maintain any type of lifestyle, or they'd have to sell everything they own and
Right.
completely change their lifestyle. So, yeah, and not saying that doesn't happen, but that's the situation people find them in. You might need 250, 250,000. You might need 5 million. So you have to figure out where you're at and what your goals are. If my goal is to buy a $350,000 luxury RV cruiser that looks like an elite tour bus, you see these out there. I see retirees with these things, and they're hundreds of thousands of dollars. But did they just, if you have 250,000 saved for retirement and you want to buy a $300,000 RV the first year you're retired, you might be in trouble, right?
Yeah, probably the numbers aren't going to pencil out on that one. But so, Tony,
Yeah.
what I wonder is you bring up this RV a lot. I know you love the rock star lifestyle. So I just want to know,
Sure.
which one are you buying and what is it going to say on the side of the bus? Because people are going to think you are a touring rock band, right? That's
Well,
the idea.
you're on to me in that I would love one of those luxury RVs, but I at this point it's not financially realistic, so I have to live vicariously through the seniors that have done better at started earlier than I did. Right? Had I done what my daughter's doing, like when she was 21, she started putting $200 a month into a Roth IRA. And because I told her to, and she, I drove this home to my kids. I wish my parents had sat me down and said, "Look, here's what has to happen, and you're going to be successful in life if you do this,
And
and
who's going
you
to
will
miss
be
$200 a month? But you look at what it's projected to be by the time she's 65.
millions of
I think
dollars."
it's yes. And
So
Warren Buffett quoted the eighth wonder of the world is compounding interest.
it
So the
is, it
earlier you
is,
start, the
yeah,
more it compounds, the bigger it's
yeah,
going to grow. So
yeah,
I'm
and
glad that
more than
she's doing that.
likely, it's not nothing
Right.
in life is guaranteed, but if the market trajectory does what it has over the last 100 years, she will have millions of dollars. But, past performance is not necessarily indicative of future results. We have to say that. But we also have 100 years of history in the market. We can just look at and pull up that graph of shows exactly what it's done. But again, you don't want all your eggs in one basket. You don't want it all in stocks in the market anyway. So, you've got to have diversity, right?
Right. So that article, the Kiplinger article, just some of the things that we can extract from it. It's if you're getting closer to retirement and you're wondering, can I retire early? And we talk about this quite a bit on the show. If you leave the workforce and you're under 65, you're going to have to find healthcare on your own.
Oof.
So before you think, is this something I should do? Just start to look at healthcare plans. And are you going to be comfortable paying out of pocket for your own healthcare plan before Medicare kicks in? So that gap between 60 and 65, Medicare kicks in at 65. If you're not quite to that age, but you're thinking, I don't want to work any longer, figure out your healthcare situation first. Look into that. That's the number one thing that people tend to not think about. They see this pile of money. They think that they can afford to probably live off of their savings without factoring into a very large expense, and that's healthcare.
Yeah. Well, yeah, that's true. And I think that healthcare, you're right. If you retire before 65, before Medicare kicks in, you're going to cover 100% of that healthcare insurance and healthcare coverage and copays and everything on your own. And that is rough. That's really expensive. People don't realize that while they're employed, their employer's probably covering 50% of it in many cases. Plus, it's a group policy. So you're getting a lot of benefits that you won't be with Cobra or with even the exchange or just self insuring. That's tough.
Yeah. So that's one area to look at. And lastly, I just want to wrap it up with this. It's something I've been working with a couple of my clients before retirement, before putting a plan together. One of the main things that they should be doing is looking at just estate planning considerations.
Sure.
So as you reach 60, 65, and you have not already done so, putting together something like a will or a trust, power of attorneys, healthcare, medical directives, uh, it's extremely important to make sure that all of your wishes that you want to have granted are done so properly.
Yeah. I would agree with that 100%. That's really important. You don't want to leave your loved ones in a bad situation. That is for sure. You don't want to leave them with a tax burden. So there's a lot to consider here. And Michael, I know this is what you do. You look at everything: taxes, healthcare, retirement income, your savings, how to grow it. So, how can our listeners out there get a hold of you to set up a no charge, no obligation consultation?
Yeah, there's a couple ways. They can give us a call, 916-469-9016. That's 916-469-9016. Or they can go to our website, thematterfinancialgroup.com, and there's a Calendly link. You can set up a consultation with us, pick a time that works for you, and do it digitally.
Do it digitally. All right. The matterfinancialgroup.com is the website. 916-469-9016 is the number. Give Michael a call. Thanks for tuning in, watching, and listening. That does it for today's episode of the Matter Financial Report with our host, Michael Matter.